want to welcome everyone to the video series we're going to be doing on leases. Today we're going to cover capital leases and I'll give you a quick overview. These are the 5 criteria that you need. You only need to meet one of those to be a capital lease. If title transfers at the end of the lease term, if you have a purchase option that's a bargain price, it's a capital lease. If the lease is for the major part of the asset, it can be classified as a capital lease. And I have the 75% on there because that's what it's kind of recommended by FASB. And the present value of the lease payments, minimum lease payments, is also, if it's for a good portion or all of the fair market value, it's considered a capital lease. And they use the 90% criteria. And then the other one is if the asset is very specialized in nature so that it's not, you can't use it for anything else, it would be a capital lease. But can keep in mind, it only has to meet one of those 5 criteria to be classified as a capital lease. So today what we're going to cover is operating leases, which means they don't meet any of the 5 criteria. So what we have here is the example. It costs $726,426 was the cost of the asset to the leasing company. We're going to use an implicit rate of 10%. The term is 4 years out of 6. Okay. So we know there's no title transfer on this, there's no purchase option, and the term is for less than 75%, it's for 2/3. So what we need to consider, and it's not a specialized item, so the only way it could qualify would be the minimum lease payments is going to be greater than 90%. Okay, so that's what we have to do here is find out what the minimum lease payments are. Okay, equal round. I use a round function on this. So the present value, the rate was 10%. Now if this was quarterly, you divide it by 4, but it was not quarterly, so we're not going to worry about that. Number of periods is 4, and you do the same thing. You take that times 4 if it was quarterly. And the payment then is a negative $150,000. And then we're going to put in 2 commas because I went to the type, and we want a 1 there because this paid at the beginning of the year, and then a comma 0 because I'm rounding to 0 decimals to keep life easy, take it a little bit easier. We don't need to have cents in here. Okay, so the present value then is $523,028, and here I already have it calculated out. I'll double click so you can see what I did. I took $523,028 divided by the cost of $726, and when you did that, it found it was 72%. So that is less than the 90% criteria that's recommended. Okay, so then we can do our first entry here. We're going to do the lessor's books first because they're probably the easiest to do on this. We don't really care for the lessor at the initial. There's no entry for the beginning of it. Okay, we don't transfer the equipment to the other companies because it's not a capital lease, so there's no entry for that one. However, there is an entry for the $150,000. Okay, so that's $150,000, and the deferred revenue is $150,000. That's for the January 1st payment. Then for the December 31st payment, okay, well, it's not payment. We have to recognize that lease revenue now as revenue. So we take that $150,000 and move it into the revenue account because we've earned it now. And then we have to record the new payment of $150,000. Get the right zeros on here. There we go. $150,000. We'll start doing this so I don't have to count the zeros. Okay, $150,000. So that's record the second payment on 12/31 of 20. Now we also have to do the depreciation. Well, since we're keeping the equipment, the lessor depreciates the equipment. So we take the equipment, the $726,426, divided by 6 because there's no salvage value. We're keeping this pretty straightforward and straight line. So that's $121,071. And then that's going to be the same dollar value. And then here we want to recognize this as revenue, so we take the $150,000. Okay, I already have it there. That's lease revenue. This is for the next $150,000. And then this is for the depreciation again, and it's going to be the 121,071, just like we did before. It's over 6 years because we're doing straight line to keep life easier. Okay. And then here again, it's the 150,000 deferred, and then cash and deferred lease revenue is 150,000 for the next payment. And your depreciation, you get the idea how this works. It's going to be the same, 121,071. Okay, so it's 150,000 all the way down. Okay, this is recorded as revenue. This is for the next payment. Then at the end of the next year, you'd have to recognize this as lease revenue at the end of the next year. Okay, so it keeps on going. Now for the lessee, however, we'll do the lessee's books now. We know this is going to equal the 523,028. Okay, so that's to put it on your books. So this puts it on as an asset, and then it puts it on as a liability. Then we need to do the chart. I mean, I could do the chart earlier, but I didn't. The lease payments is the 150,000, and that's 150,000 all the way down because it's the same payment. This one is also the 150,000 because no interest has accrued yet. So we'll take this one, the 523, and subtract off the 150,000. Okay, now for this is for the interest at the end of the year. We take equal round, the 373,028 times the interest rate of 10%, and like I said, it's 0 decimals, so that's 373. And then we'll want to subtract. Like I said, I just use ABS all the time. Because it's 150,000 minus the 373 gives you 112, and then take the 373 minus the 112. Okay, and I did it again. I want an absolute value of the B3 because otherwise they'll come up with a strange number. Then I can copy that down, and there's my chart that I need to use. Okay, so for this first one, the lease payable will be for 150,000, and your cash payment will be 150,000. And then on December 31st, we won't need no interest there because that's the first payment. It's the leased interest expense is the 37,303. Lease payable is 112,697, and the cash is 150,000. Okay. Now for the lessee, since this is an operating lease, we need to amortize the asset that we have, and the amortization is the difference between, so like your depreciation is the difference in the interest that you've already accumulated, that you've accounted for. So it's like depreciation type thing. So we would take the total payments. Let me back up here. I didn't do this. Okay, so total payments are 600,000. Okay, so we have equal. I'll do the round function, just to be safe. We take the 600,000 divided by 4 because it's a 4-year lease, minus the interest that we've already accumulated in common 0 because I want 0 decimals. So it's 112,697. When the payments are equal, the reason why I do it that way, when the payments are equal, it'll always equal the lease payable up here. But if you have unequal lease payments, then you need to take an average for the amortization expense. Okay. Okay. So with this, then the interest expense on the next one is the 26,033. And then you have 123,697. And of course, then this one is equal to the 150,000. And your amortization expense on this would equal the 600,000 divided by 4 minus the 26,033. Okay. Now I didn't use the round function on there just to save some time. Okay. But if you did the round function, always put it in later if you want. Equal round. Then hit the end key, comma, 0. There. Okay. So that's the amortization. Again, the total equals 150,000. Because when you're done with this, remember the rate to lease asset up here, this one should be 0. Okay, in 1222 then, we have interest expense of 13,636. Lease payable is 136,664, and of course your cash is 150. And then your amortization expense on this one is equal to, okay, I'll just put the round function in there. The 600,000 divided by 4 minus the 13, comma 0, gives you 136,364. Okay, so that's your operating expenses and what you would have for it and how you would do that. And that should take care of the operating expenses. So there's the lessors, here's the lessees, and I guess hopefully that helps a little bit. And then at the end of the lease, of course, the equipment goes back to the lessor, and you're finished with the lease. So the next one will be on the financing lease, probably for the lessee. Okay.